Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money-making world. And boy do we have a story about Ondas Holdings Incorporated today. This company has been busy. You will not believe what they have been up to in just the last 3 months alone. Now before we deep dive, if you appreciate getting straight insights from these important corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we break down these kinds of documents every week so you do not miss out on anything important. Ondas Holdings Incorporated, known for its drone and private wireless tech, has just dropped its quarterly report, and it is a roller coaster. They have been making some major moves with big money flowing in, but also some hefty expenses. We are going to break down the key financials, what these deals mean, and the underlying story behind these numbers. Let us start with the big picture, what the company owns and owes. As of the 30th of September 2025, Ondas Holdings reported total assets of a staggering $550 million. That is a massive jump from $109 million at the end of last year. Where did all that cash come from? Well, you will see a lot of it came from selling more of their stock. This means they are fueling growth and expansion, but also diluting existing shareholders. Look at their cash position. It exploded from about $30 million to over $432 million. This huge influx is largely due to their recent stock offerings. They are certainly not short on cash right now, which is critical for a company in the fast-paced tech sector. Now, this is where things get really interesting. Their additional paid-in capital soared to over $754 million. This is the money they received from selling stock beyond its par value, which is a lot. However, look at their accumulated deficit, a whopping $268 million. This means despite all the cash, they are still operating at a loss overall. They are burning through cash to grow, but have not yet reached profitability. Let us talk about revenue. For the 3 months ending the 30th of September 2025, their total revenue hit over $10 million, up significantly from about $1.5 million in the same period last year. This is a solid sign that their products and services are gaining traction. The OA segment, which includes their drone and robotics business, is the star here. Revenue jumped from just over $1 million to over $10 million. This massive growth is what is truly driving the company forward. And look at their gross profit. It went from a tiny $47,000 to over $2.6 million. This means they are not just selling more, they are selling more profitably. Their cost of goods sold did increase, but not as much as their revenue, which is exactly what you want to see. However, this growth came at a cost. Their operating expenses more than doubled from $8.7 million to over $18 million. This is a direct result of their aggressive expansion strategy. They hired more people, spent more on research and development and marketing. A big chunk of that increase is human resources. In just 1 year, their personnel cost went from 38% of their total expenses to 61%. This clearly shows they are investing heavily in their team to drive innovation and sales. With those rising expenses, it is no surprise their operating loss also grew. It went from $8.6 million to over $15.5 million. While the revenue growth is strong, the company is not yet covering its operational costs through its sales. Now, for some very good news here, their other income shot up dramatically from an expense of $865,000 to over $8.3 million in income. This is largely thanks to interest and dividend income received on all that new cash they raised and unrealized gains on their investments. It is a smart move to put that cash to work. So even with that boost from other income, their overall loss before taxes still narrowed, mainly because their operating loss grew less than the other income increased. It is a complex interplay, but the net effect is their reported loss for the quarter actually decreased from $9.5 million to $7.4 million. At the end of the day, their net loss decreased by about $2 million. This is a really positive step, although they are still losing money. What really matters is the trend, and the trend here is towards reducing losses even with massive investment. Looking at the 9-month period, the revenue story is even more dramatic. Total revenue jumped from $3 million to over $20 million. The OA segment is clearly the engine driving this growth, and that revenue growth translated into a significant turnaround in gross profit. They went from a gross loss of over $500,000 to a healthy gross profit of over $7.4 million. This is a major win and shows their products are becoming much more efficient to produce and sell. However, just like the quarterly results, their operating expenses also ballooned for the 9 months. They went from expenses of $25.5 million to $42.4 million. Again, this points to substantial investment in people and R&D. This increased spending naturally led to a larger operating loss. It grew from $26 million to $35 million. So, while sales are up and gross profit is way up, they are still spending heavily to get there. Their other income also saw a huge boost for the 9-month period, going from an expense to over $3 million in income. This is from their investments and interest earnings on the large sums of cash they have recently acquired. And finally, their net loss for the 9 months increased by about $4.7 million to $32.3 million. Even with the revenue and gross profit improvements, the significant increase in operating expenses outweighed those gains, leading to a wider net loss for this longer period. Let us talk about cash. The company's cash position at the end of the 9 months is truly remarkable. They went from just under $3 million to a massive $433 million. This is thanks to those recent stock offerings providing them with a substantial war chest for future growth and acquisitions. However, it is important to note that they are still burning through cash in operations. They used over $26 million in the 9 months for operations. This is expected given their growth stage, but it highlights the need for those capital raises. And their investing activities show significant spending. They used nearly $19 million in just 9 months compared to about $1.6 million last year. This is driven by acquisitions like Apero and investments in other companies, which shows they are actively expanding their reach and capabilities. This is where the story really comes together. Their financing activities provided almost $500 million in cash. This is almost entirely from their stock sales. The June, August, and September offerings show they successfully capitalized on market conditions to bring in substantial funds. Now, for a key point, just last year, the company's financial statements raised doubts about whether they could continue operating. But thanks to these recent massive capital raises, management believes that fear is gone. They feel confident about their ability to keep going and growing for at least the next 12 months from the date of this report. This is a significant turnaround in their financial standing. Let's touch on stock-based compensation. The company has been granting lots of stock options and restricted stock units to employees and executives. This is a common way to attract and retain talent in the tech world. For the 9 months ending the 30th of September 2025, they recorded over $6 million in stock-based compensation for options and over $2.5 million for restricted stock units. This is a significant expense but is aimed at incentivizing long-term performance. Looking at subsequent events, they have been incredibly active. Right after the quarter ended, they acquired Smart Precision Optics, a company based in Israel specializing in optical systems. This shows their strategy of inorganic growth continuing to expand their technology portfolio. And just days before this report was issued, they announced another major acquisition, this time of Century CS Limited for a whopping $125 million plus stock. This demonstrates their ambitious M&A strategy aiming to consolidate and grow rapidly. So what is the verdict on Ondas Holdings Incorporated? On one hand, they are showing impressive revenue growth, especially in their OA segment, and have successfully raised a massive amount of capital, which has turned their going concern concerns into a distant memory. They are investing heavily in their team and making strategic acquisitions to broaden their technological capabilities. However, we cannot ignore the rising operating expenses and the significant accumulated deficit. While they are growing rapidly, profitability is still a future goal. The sheer scale of recent spending on personnel and acquisitions means they need to execute flawlessly to turn these investments into sustainable profits. The success of their aggressive expansion and acquisition strategy will be key. Their ability to integrate these new companies and realize the expected synergies will determine if this rapid growth translates into long-term value. Alright, that is our breakdown of Ondas Holdings Incorporated's latest filing. What do you think about their rapid expansion and aggressive spending strategy? Do you think they can turn all this investment into lasting profitability? Let me know your thoughts in the comments. If you found this analysis valuable, hitting that like button really helps us, and subscribe for more deep dives into corporate financials. And don't forget to join our Discord community linked in the description for more ongoing discussions. Thanks for watching, and see you next time.